Each month we're going to go through a quick macro backdrop, or what's happening in the big picture. Then we're going to be looking at some of the big movers in the small cap world. And then after that we're going to be covering a stock as a buy, a stock as a sell, and a stock as a hold. Stocks can go down for one of two reasons. Basically, either there's a crunch in their earnings is one reason, or another reason is that people forecast a crunch in earnings. In that or forecast that earnings are going to come under pressure. So this is more what's happened rather than the former, because in the reporting season in Australia we saw a pretty good reporting season where most companies beat expectations. And certainly in America, what we're seeing at the moment in their current reporting season is that conditions are pretty good. So the expectations are under a cloud for a couple of reasons. One is that interest rates have been rising pretty fast. So the 10-year bond rate in the US market has gone through the roof because there's been a big sell-off, and that's been underpinned by inflationary concerns. And secondly, I guess there are trade tensions, if not an actual trade war. So this creates sort of uncertainty, which is sort of underpinning the volatility. But we look at this as a buying opportunity because, as I said, the fundamentals of many companies remain strong, and we're seeing, for the first time, value come into the market at the small end, and we're looking to take advantage of it. NetComm's wireless is a stock that not many people might know about, but it's profitable. But you wouldn't think so, considering the stock price has fallen 50% after a profit downgrade. But the thing is, they are in a growing area, which is internet connectivity. They provide modems and routers for big companies, big wholesalers like the NBN and AT&T in the US. So they're leveraged to the growing infrastructure that's necessary for internet connectivity, and also they're leveraged to the upcoming spend on 5G infrastructure. But as I said, we do look for value, so that kind of serious fall in the share price means that it's de-risked. Certainly on the price perspective, we think it's de-risked. One stock we've covered for a while now is Spices. I think we was sort of the first people to cover it after it got restructured. It was previously Paperlinks, and they got rid of some hybrid debt, which was really like a Damocles sword sort of hanging over the stock. But they managed to restructure their operations. They sold their Singapore business and gave us 0.7 capital return. So, we've done pretty well out of that. We got in at 3.2 cents. The stock's now over 5 cents, and they've given 0.7 cents of a capital return, and we think there's a good chance that they'll start paying dividends. So this has certainly been a good news story in the paper and print market, which has been long awaited. Certainly in the past sort of 12 months, we've seen we've been promoting the fact that we think there is an element of market euphoria, and we've been trying to take advantage of that. So when we have been making good returns, we've been looking to cash in on that, and we've had like a number of take profit recommendations that exceeds 20. Main Pharma, Nearmap, Ingenia, Kogan, the names go on. But I think what this has done is put us in a good position for when there is weakness in the market, to be able to take advantage of the opportunities on the buy side. It's been an interesting period for the aged care sector because I think, as I've said, volatility's on the up, and amid that volatility, we've seen the announcement of a Royal Commission, which has really crunched the earnings expectations of these stocks, and they've been under pressure for a long time. Like Regis comes to mind, as well as Estia Health, some of the big ones who really are the big operators in the aged care sector. These companies rely on government contracts, and there's a significant risk there. On the other hand, they have been achieving revenue growth because there is undeniably a growing cohort of retirees who need care. While not playing a part in the aged care sector, when it comes to sort of nursing homes, we've been active in promoting stocks that are more in the community side of things when they're providing aged communities, because they've got really good business models and they don't rely on skilled workforces, so they haven't got the labour cost issues, and they're not reliant on government contracts. So I'm talking about Ingenia and Lifestyle. These companies have really good innovative business models that are targeted to the mass market, and that's where demand is growing, and we still see further improvements in their stock prices. We look at sectors that are under trouble, in troubled times, because that's where value can often exist. But I mean, having looked at Myers, we think that the risk reward is too weighted towards the risks at this point with their huge liability, their lease liabilities. And I think that's the case for many of the other stocks in the bricks and mortar segment. Certainly with Kogan, they experienced a big decline off the back of a downgrade. There was some euphoria there. We did take profits, but we stepped back in after some weakness. But I think, that stock, while it's going to be under pressure for a while, it remains Australia's premier sort of online retailer. So we look forward to, we'll continue to cover that space with interest. RFG, we took a look at. They're going to be, continuing to experience troubled times, or retail foods. One where we think there's a buying opportunity is the Reject Shop, where we'd previously taken some profits on, but now we're waiting in after the share price is sort of more than halved in the past month after a downgrade. While the business conditions are tough, their kind of products we think are pretty good. There'll be some resilience because they are sort of targeted towards the cheaper end of the market. Well, like in the past 12 months, we have been sort of fairly cautious about the market and looking to take profits. We've got a big issue coming up where we're going to be outlining our take profits recommendations where we've made good money, and we're also looking at from following on from Shocktober, we're looking at taking advantage of the weakness, and we've got a number of buy opportunities that we've been working very hard on. Also, we've got a double report on the medical technology area, which we've specialised in, and we've got some impressive returns.